Hey guys, we're here today with Kevin Muir. I'm really excited to have Kevin on. I've been following him for a very long time, all the way back when you weren't monetized, and then your famous letter from when you went monetized. And still today, I still follow the Macro Tourist. It's a great channel. They also have a great podcast, so you guys should definitely check that out. I want to bring Kevin on for a bunch of reasons today. One, he's always talking about very similar things to me and he has a great way of articulating it. You know, some things we wanted to cover today was the U.S. dollar rally, Trump as the tariff president. So that's something that I've been talking about a lot, and you guys have had a lot of questions about. So we want to cover that as well. Post-COVID policy shift, something that Kevin brought up earlier that I think is going to be a fun thing to go through. Bonds, you guys know I love to talk about bonds. I could talk about bonds all day. Excited to do that. The Canadian dollar, gold, inflation risk. Man, there's so much going on out here, Kevin. So, first off, how are you doing today? I just want to thank you for coming on and joining us.
It's my pleasure. Great to be on the show.
I'm so happy to have you because there's so much happening in the markets right now, and January is just starting and kind of seeing the relative strength flow into certain areas like oil, like the reflation
Yeah.
trade basically just picking up beautifully so far, inflation picking up like crazy. Granted, it's not showing up in the reports just yet, but it's showing up in the price, and that's going to come into the reports at some point. So, first off, the US dollar rally. That's something you mentioned here just to start this off. So we got the US dollar. It's
Yeah.
been rallying. What are you seeing with the US dollar and why is it the last thing that Trump wants?
Well, Jason, first of all, I've been talking about the fact that with Trump being elected president, that we are about to embark on probably one of the most exciting periods for macro trading than we've seen in decades. Literally, I laugh and say that this is like back to the good old days of Soros and Steinhardt in the 1980s when there was big moves in currencies and bonds and stocks, and there's a huge shift occurring. And that shift occurring is occurring because if you think about the past kind of couple of decades, ever since 2000, we've had this situation where it's all been the same thing. Interest rates until COVID, but during kind of the post dot com bust to COVID, we had this situation where interest rates were headed lower and everything was this kind of disinflationary, very stable, very boring period. Like think back to 2017. I think it was the lowest realized volatility in the S&P 500 that had been seen in just it might have been in history. I can't remember the exact figures, but it was boring and it was ultimately this just kind of suppression of volatility by the central bankers. And then what happened is in COVID hit and we changed the environment. We went from one that focused purely on kind of trying to fix the business cycle with monetary means, meaning focusing on moving interest rates, to one that moves with fiscal means. And that was when we introduced fiscal stimulus. And as we all know, they did too much of it. The point being, though, is that we had this kind of very definite shift. It would occur. The first shift occurred in the great financial crisis when we did extraordinary monetary policy. We introduced QE, all those, nasty things. Then another shift occurred when we had the COVID situation, and that introduced fiscal. And I think we're in the midst of having another shift that is with Trump coming in, and Trump is introducing tariffs. And if you go look at tariffs over a kind of the percentage of the taxation revenue that was raised by tariffs in the U.S. over the past 200 years, it looks like this huge like line from the top left to the bottom right. And for the past 30, 40 years, it's been zero. Now, all of a sudden, we have Trump coming in here and he's trying to change the whole way that the economy works. And he's pushing for these tariffs. And that's fine. We can argue about whether it's good or wrong, good or bad for the economy, but that doesn't really matter. The reality is it's going to change the economy. And that is what's exciting about it. And that's why macro trading is going to become so great again. There's going to be huge moves in currencies, in bonds, in stocks. We're going to see this volatility go up. And one of my big themes, Jason, is that in the past, I used to hate buying volatility. For those who don't understand what that means, it means I didn't like expressing my views and options because you always had to be not only right on the direction of the trade, you also had to be right in terms of the timing. Yet now we have a situation where I expect the volatility, the up down of the markets, whether it be stocks, whether it be bonds, whether it be foreign exchange, to be so great that you're better off having that optionality through owning these options. And so when you go back to your question, what's going on with the US dollar? This is the first part of this trade that when people ask me, well, before the election, what do you think happens if Trump wins? I said the initial reaction will be for them to buy everything. They will buy stocks. They will buy the US dollar because money will flow into the US because of this kind of excitement about the deregulation, about him cutting taxes, and it'll be this mad scramble. And sure enough, that's what's happened. And the US dollar rally has been just off the charts. If you go look at the kind of the previous US dollar rally, well, the last time he won, this one eclipses it by a huge amount. And I think that one of the things that people are missing is this rally is actually not accomplishing what Trump wants in terms of if he's trying to bring back jobs to middle America, which is what he says he wants to do, then this rally in the US dollar is actually counterproductive. And that is kind of the crux of the problems that we're experiencing now. That in essence, what's happening in the US dollar is counterproductive to what he was elected to actually institute.
Yeah, and I think it's fascinating. I just wrote a report about this the other day. It's the one thing I would love to talk a little bit more about this and dig deeper in with you is, are we seeing this the situation that people have said, the argument, hey, if Trump's in office, the dollar has to continue to go up because Donald Trump is in office. What I
Right.
think was interesting is if you go back, I just wrote a piece on this the other day, which is the dollar was falling, the first couple years, that same time we're seeing that incredibly low volatility in the S&P 500 that you were talking about. The dollar was falling, basically 2017 to 2018. So what I love about your research is how you kind of dig into figuring out the truth instead of like letting a lot of people are letting their politics kind of color it. So I really enjoy your research in that. So the one thing to dig a little bit more into is, what about tariffs? He's the tariff president. How does
Right.
that affect the dollar?
Well, so this is the real problem. And let's just stop and think about why he wants tariffs. He wants tariffs because he believes that the trade deficit is stealing they're basically getting taken advantage of. You'll hear him talk about this all the time. He'll say, I'm a Canadian. He'll say that you guys are taking advantage of us by $200 billion a year. And that is our trade deficit. That's the US trade deficit with Canada. And what he's thinking about is that we're stealing jobs. And actually, let's use China because China is a better example than Canada because we're kind of unique in that we we sell you guys lots of commodities. But let's use China. China will have a big, huge trade deficit. Those are the result of Americans buying Chinese goods. And when they go buy those Chinese goods, the middle American jobs they used to manufacture those goods are lost. The easiest one to kind of let's just use tractors, for example. Tractors used to be made all in America, John Deere, Case, all these terrific companies that were the pinnacle of American capitalism. They're all finding themselves going to Mexico or going to China or getting competed against with other products. And the what Trump was elected on was to basically bring that trade deficit back to zero. And he thinks that if he could bring that trade deficit back to zero, then he will be able to bring back the jobs that have been lost in mid America. And he's not wrong in that a lot of those jobs were lost and that it is a very destabilizing event for society. And it goes back all the way to free trade. If we think back to when we kind of made this shift in terms of this free trade, when China entered the WTO, the World Trade Organization, in 2001, the idea was we were going to be able to buy cheaper things from America, from China, and then the people that lose their jobs would be able to go find better jobs. America would be able to go and specialize in something else. Well, that's really like maybe that happened a little bit, but it didn't happen nearly enough. So what happened is we had this hollowing out of mid America. And Trump actually realized this, and he was elected on the idea of bringing back these jobs. And like just John Deere, he said, if you go and move your jobs to Mexico, I'm going to put 200% tariffs on it. So at the end of the day, the reason he's doing those tariffs is because he's trying to bring back manufacturing jobs. Now, let's just stop and think about what's happened over the past 20, 30 years as we've gone into freer and freer trade. As we've gone and created a situation where America makes less things, okay, and they buy more things, they have this trade deficit. And so if you're let's use the Apple iPhone because that's a good example of it. When you and I go buy an iPhone, although you might be an Android guy, I don't know. We go
iPhone
buy
guy.
you're an iPhone guy. So when we buy an iPhone, we buy it and we pay for it in US dollars or Canadian dollars in my cases, but US dollars. And if we were in a truly free trade environment, if there was a situation where enough people bought Chinese goods, the renminbi or the yuan would rise. As you know, we bought more of those Chinese made iPhones, the price of it would rise. But the trouble about it is that the Chinese government has realized that they have all these people in the that they needed to put to work. And they say we can't let the renminbi rise because if that'll happen, we won't be as competitive and we won't be able to put people to work. So what we'll do is the kind of Foxconn, the company that sells the iPhones to the Americans, they need to pay renminbi for their workers, but they're stuck with US dollars. So the People's Bank of China steps in there and says, you know what we'll do? We'll issue you the renminbi that you need, and we'll keep the US dollars. And so this is the kind of the essence, the how trade deficits have been created. But if you think about that relationship, what's occurring is that the US dollars are staying in the US financial system. So on the one hand, the way I like to joke is that the trade deficit, the deal that America's made with the world is they buy all of the world's stuff and they sell them overpriced financial assets because that has to be on the other side of the trade deficit kind of equation. It's all accounting. There needs to be something on a trade deficit has to have something that you guys are selling them. And that what you're selling them is investment assets. And that's ultimately part of the reason that America has been so exceptional in terms of its performance with its financial markets is because it's a big, deep, liquid market and people want to go to America and they want to leave money in there. And then once the money's there, it makes funding new companies more exciting and it makes it easier for them to do it there. So it feeds upon itself and it creates more growth. But at the end of the day, all of that, new excitement, things like that, it's not creating a ton of jobs. It's not helping the guy at the John Deere factory. So when Trump comes and says, I want the trade deficit to be zero, I don't think he understands the other side of that equation. And the other side of that equation is if there's less money being recycled in the US financial system, it's going to mean a withdrawal of money out of the US, which will mean declining stocks and bond prices. And that's the part that I think a lot of folks miss. Now, I'll just tell you one kind of really, when I talk to people about this and I talk to some smart guys, they'll say to me, Kev, I completely understand. I'm not disagreeing at all. The trade deficit on the other side is the financial asset, account. And there's no doubt about it. If Trump got the trade deficit down to zero, it would cause stock prices to go down. The argument is, and this is something I don't have an answer to, but his argument when I talk to some smart guys about this is they say, but Trump really doesn't want that. He just says he wants that. And that's the real kind of crux that you need to think about as you're examining how the macro environment plays out in the coming years. And you can already see this sort of push and pull and the problems in the administration with the kind of, I call them the globalists, the Scott Bessents, Elon Musks of the world. They want the system to remain as is. There is zero doubt in my mind. Sure, they want the government to spend a little on the fiscal side, a little less on the fiscal side, But on the whole, they're happy with it. They love H-1B visas. They love keeping labor as a percentage of the economy down. And on the other side of the equation is the Steve Bannon's and the Stephen what's the starts with an M Miller of the world, and they're much more, and Robert Lighthouser, and they're much more wanting to you know, do the rechange the U.S. economy to help that mid America. And so when you're thinking about how this plays out, right now, everyone's rushed into the US market, assuming that the Scott Bessent Elon Musk equation is going to work. That is who is going to, win out. And my argument is, hey, wait a minute. You could be right, but you're paying up for a market that's already very expensive in a currency that is one of the most expensive currencies in the world. And not only that, if you listen to what Trump has promised, what he actually wants to achieve will be negative for stock prices and bond prices, and more importantly, the US dollar. Because let's just go back to the John Deere example. You can put all the tariffs you want on tractors, and you can make it so every single tractor that is bought in the US needs to be American made, and that can occur. But if the US dollar stays at this elevated price because everyone's putting in financial assets, they're chasing it on a financial basis because of this, financialization and this, mad rush into AI and things like that. Everyone's putting buying US dollars. If the US dollar stays expensive, then that tractor manufacturer will never be able to compete. So you will never be able to do any more than just sell the US ones in the US market. That will be it. And even if you accomplish that, if you stop and think about it, what you're doing is you're forcing capital to choose an inefficient kind of non-profit maximizing result. And yet we just said that the US is one of the best at making profits and figuring out how to, take advantage of globalization. And then you're forcing the opposite on them. So I think that the market is very confused and is just seeing the absolute best parts of the Trump policy without thinking through all of them.
That's a great point. And that also brings me to all I'm thinking about as we're talking about this is thinking about home country bias. Like United States citizens, if you were to tell them like even like saying like something, the dollar's going down. That's usually, positive for some equities, usually real economy style equities and so on. But global equities as well. But I've been talking about a couple, we're getting buy signals in certain areas that we haven't seen in years. Chile was one of them the other day, Poland, weird things that we haven't seen in a long time. So, I wanted to ask you a little bit, what do you think about Americans and their home country bias? And should we be looking for other areas to invest in at the moment? So many people are just so stuck in, I have to buy American. What do you think about it globally at the moment? Do you think there's an opportunity there, or do you think it's something that, it's been getting beat up for years, it might continue to get beat up?
So I don't think it's just the Americans that are suffering from country bias. Well, I shouldn't say home country bias. I should say American bias.
Mm.
And if you go look throughout the world, the one trade that everyone has on too large is overweight American equities, overweight American dollars. And it's back to what I just discussed. The reality is that the American market has been crushing everyone, absolutely crushing it. And if you weren't overweight or at the very least fully invested at the proper benchmark, you were fired. And not only that, it's become this self-fulfilling prophecy, like it's going up because it's going up. And if you in the reality is, even now, like I think that this last 2 months is absolutely ridiculous that the US dollar is rising, because I think Trump doesn't want a US dollar. I go back a higher US dollar. If you go back and read the Bloomberg Business Week interview he gave in the summer, he very explicitly said, I think the Chinese renminbi and the Japanese yen are too low and they need to go up in price. And everyone says, oh no, he wants the US dollar to be the reserve currency. And I always go, listen, The reserve currency doesn't mean it's the strongest currency. It means it's the currency upon which everyone transacts in. You can have, you can be the reserve currency and actually have it going down. So when you're going back and asking about the Americans' overweightness of American stocks, I think it's much bigger than just America. I think it's the whole world. I think you go and look at like European pension plans or Norwegian, sovereign wealth funds or Saudi Arabian sovereign wealth funds or Japanese retail investors. Everyone is overweight the US stock market. And I know it feels great right now. I know it feels like, oh, there's no way they can lose money. Everything's great. They're like this line I hate this, the cleanest dirty shirt. Why would I
Yeah.
put my money anywhere else? And I always tell people this is the kind of that dirty shirt thing really makes me mad because I said you don't actually need to be bullish these other countries. All you need to do is be less bullish the US. And if that occurs, what'll happen is the European pension plan that is overweight US stocks will sell American stocks and buy European stocks. So what's called a return to benchmark weight could be enough to just cause the rallies in these other markets. And I am petrified about the fact that American stocks are the most concentrated in terms of the top 10 stocks, their percentage of the S&P 500 that we've seen in decades. Goldman Sachs has this great chart and they show concentration risk. And the only time we've been this concentrated in the past was 1929. And then interestingly enough, when you go look at the other times that this has occurred, this sort of concentration, it was like the Nifty 50 and then the dot-com bust. And all these periods were not great times to be investing for the long run. So there are so many things that are screaming that American stocks are overpriced. Everyone owns too many of them. And I understand all the reasons they're going up. But if you're a long-term investor and you're thinking about this in terms of allocating with a 10-year time horizon, then the time to be buying stocks is long past. And in fact, you should be selling. And I'll just talk about one last thing before I throw it back to you, Jason. There's something called the equity risk premium. And the easiest way to think about that is like to look at the earnings yield of the S&P 500, like how much it earns, and put it in terms of a yield. And then you compare it to the like bond yield. So it's a risky yield versus a non-risky yield is a way to think about it. In March of 2020 or maybe April, it was something I can't remember the number, but the S&P 500 had, let's say, a 6.5 earnings yield. Okay. And the bond market, the 10-year was trading at 50 basis points. So the equity risk premium, meaning the amount that you got paid extra to take the risk of owning equities, was 6%. Now that 6% has gone the other way, and it's flat, meaning that the earnings yield is 4.5, and so is the 10-year bond or the 10-year T note. So when you look at that, you might say, well, that's not really like that should mean that I should be reallocating into bonds. And people get a little too focused on saying bonds are going down, so stocks must go down. And the reality is that relationship between bonds and stocks, it doesn't work over the short run. If you look at the equity risk premium and then the 1 year forward return of the S&P 500, meaning so like if an equity risk premium is high, what is the return of the S&P 500 over the next year? It almost looks like a scatter part, like someone shot like a shotgun or something. It's all over the map. There's no relationship at all. But then if you look at it over a 10-year time frame, and my buddies at Ruffer have this great chart, it is so obviously a relationship that holds water, meaning that the lower the equity risk premium, the lower the 10-year returns are. So I can't tell you here that we're not going to go and scream higher because there's a definite chance we will. I happen to believe we might be in the midst of the final stages of a bubble. And the thing about bubbles is they can move a lot faster, a lot quicker than anyone can imagine. I don't know what's going to happen over the next 3 months, but I feel like over the next 3 years, it's pretty clear to me that US stocks are going to underperform.
No, I love that because it's really kind of screaming that in a bunch of different areas. And so speaking about those areas, let's start getting into, bonds.
Okay.
And you mentioned this, and I want to hear your opinion. I have a feeling I kind of know where you're going, but I really would love to hear your opinion. So why poor performance hasn't crushed US stocks? I'd love to hear this one.
Why bonds? I mean, why the bonds hasn't actually kicked into caused stocks to go down?
Yes, yes.
Um, okay, so there's a few things there.
So basically, just get a little bit of a backstory. Bond prices have been taking a hit, just moving down for the last 4 years. I think it's its worst 4 years in history. It's had
Right.
four down years in a row. So most of the time, this puts some pressure on stocks, especially as yields get to certain levels. So I'm passing it to Kevin. So yields up this high, stocks are up. What exactly is going on with this relationship right now?
Yeah. So as I just mentioned, this idea, first of all, it'll work. That relationship will work over the long run. It doesn't have to work over the short run. And then the other part of it that a lot of people miss is why are bonds going up in yield? If they're going up in yield because the economy is much stronger and we're getting more growth, then actually stocks can continue to rise because we're getting this kind of almost nirvana for stocks in terms of economic growth. So it's not necessarily that you hit this point where, okay, if rates go up, that means the stock market's going to get into trouble. The reality is rates are going up because the economy is so well, which is actually positive for the stock market. And then not only that, there was this huge move into bonds in that scary point during COVID or even during the whole past decade where the stock market performed poorly and there was not very much actual economic growth and people were overweight bonds and underweight stocks. And so what we're seeing now is a move out of those bonds into stocks. So what you need to kind of reach is a point where when does the bond market actually cause investors to switch? When do they start saying, okay, you know what? This is enough of a rally. I'd rather own the certainty of a bond over the riskiness of the stocks. And this is why there's no just kind of moment where you hit this level, this is the level, and then all of a sudden stocks don't go up. If you go and ask most people the question whether they should own bonds or stocks, they'd be like, why should I own a bond that earns 8% if I'm talking about a corporate? My stocks are going up 20. Like that's where we're at. We're at this just kind of manic moment. And eventually you will get the big long-term money making that shift, doing that. And you listen to this. One of my favorite guys to listen to is Howard Marks, the founder of Oak Tree. And he talks about that. He's like, why would you go? And if you're sitting there and you're administering a pension and your goal is to hit 8%, and that's kind of often what their goals are, and usually, what they would have to do is bonds would yield 4 or 3 or something like that. And then they would have to mix it with equities to get to the 8%. They'd have to mix a risky asset with it to get to the 8%. Now, all of a sudden, you can go and you can buy a corporate bond and you can achieve your 8%. So the long term money should be making that shift. It's just that it doesn't happen overnight. And not only that, we're still getting overwhelmed with people just chasing the um, the latest fad. And so it's not quite that easy. And there's more to it. Even like we can start talking about fiscal because there's the fiscal thing that I mentioned in 2020 that influenced it as well. There was a huge re-rating in terms of if we remember back to the post GFC period, there was very little economic growth, so people overpaid for the certainty of bonds. Now all of a sudden we're getting much more growth, and that's why people are almost more excited about overpaying for the potential of growth in the equities as opposed to the certainty of the bonds.
No, that's well said. And that leads it to, the next question. This is flowing really well. I appreciate that, Kevin. Coming into the next one. And if Gene, we go to chart three here. Let's go to chart three. It's the Dow relationship between the Dow Jones and crude oil. And so basically looking at this here, And we're kind of getting at those levels where we usually see reversals. Now, once again, there's no perfect level in that. But like you said, there's a level where people say, okay, I'd rather be in this over that. So the one thing that you were talking about, and you've talked about this a lot lately, what's the inflation risk out there? Because what I'm seeing is, we're starting to see commodities start to outperform just at the beginning of the year. It's nothing to be alarmed over yet. However, it's something that you and I had talked about before that was probably going to happen this year. We talked about it for 2025. What are you seeing for the inflation risk out there? Because this is, a lot of people follow the gold rush to get a lot of information on gold, inflation, commodities. So what are you seeing out there?
Okay. I've been an inflation bull for a long time. I even before COVID, I was very much in the camp that believed that the inflation was the inevitable result of where we were going to have to be headed. And people used to talk to me about what they called the three Ds. They would say debt, demographics, and disinflation from technology would mean that we were unable to create inflation. And I know it seems kind of just hilarious to think about now, but I used to get hedge fund managers that would tell me pre-COVID that there was no way we were ever going to have inflation again. Like seriously, they would sit me down and tell me, all this crap about you talking about inflation, there's no way we're going to have inflation. And I said, listen, I am not denying that your three Ds are um, influences that make disinflation more likely. But I always said with enough political will, you can always create inflation. And that was what ended up happening with COVID. We went from a period where we only responded with monetary stimulus to actually focusing on fiscal stimulus. And just a little backdrop, up until COVID, we had done this monetary stimulus, and the way that we had kind of tried to get ourselves out of every single economic downturn was by lowering rates. And by lowering rates, it would hopefully encourage the private sector to borrow more. And as the private sector borrowed more and more, they became less and less willing to borrow whenever the rates were lowered. And then, in fact, what you had to do was you had to lower them even lower than the last time to get them to borrow even more. So if you go look at the Fed funds from 1982 to 2020, you'll see that every single decline was met with a kind of an increase, and that increase was lower than the previous increase. And then the next decline was lower than the next decline, and it had this stair step thing as the Federal Reserve encouraged more and more people to borrow money. Then 2008 hits, and they lower it to zero, and there's so much private sector debt, the private sector just says, no, thank you. I don't want any more. I'm not going to borrow anymore. And that's what Richard Koo calls the balance sheet recession. Now, they then go and try to do QE, Operation Twist, all these extraordinary monetary policies. And we now, in hindsight, know that these don't work. And they just don't. They might cause financial asset inflation, but they don't create any sort of actual economic benefit. And in fact, you might even argue that they're negative. And then what happened was when COVID hit, were aware of the kind of impotence of their policies during the GFC. And so this time they did monetary stimulus, but they made it along with fiscal stimulus. And the problem is they did way too much. And this has always been the people who have said this is a dangerous precedent to take because once the government realizes they can spend as much as they want, they're going to spend too much. And I have never disagreed with that. I've always been in the case that once they figure out that there's not some sort of magical barrier stopping them from spending, they're going to overdo it and they're going to create inflation. Because if you think about it, we have too much debt, and the way to do it, fix it, is to actually, create money and diminish that value of the debt by inflating it away.
Mhm.
So now we're back to this environment where the question is, are we going to go back to the post GFC, pre COVID environment of trying to balance budgets? Like, don't forget, that was the Tea Party. That was the government trying to, pull back on spending. Are we going back to that? Or are we going to have this return, this continuation of what Biden did? Like if you consider the fact that the US deficit was 7% in a period of no recessions and no wars, it is the most stimulative, fiscal stance that the government has ever taken. And it's just batshit, sorry, I didn't know, am I allowed to swear?
Oh yeah.
Okay, it's batshit crazy. And it was, and that is ultimately what caused the inflation. So you're asking me, what does inflation look like going forward? I happen to think that over the long run, it will be very difficult for the governments to ever go back to that period that we saw in the post GFC. Um, and the real question is, do we have a cyclical decline before the government, like, do we have a cyclical decline in inflation or the economy that then the government responds with more spending? Or does it even not even get there? Do we have a pickup even before that? And I'm not 100% sure. I could make arguments both ways. And again, it comes down to this idea of what we were talking about earlier with the trade deficit. It also depends on the fiscal deficit. If Elon Musk and Scott Bessent decide that they're going to try to balance the budget and they actually do some major cutting, that would be negative for inflation. That would cause the economy to sag, and it would, all else being equal, it would cause this economy to sag and it would cause inflation to go down. However, if you ask me over the next 10, 20 years whether governments will spend more or less, I'm very much in the camp that they're going to continue spending more, that we've ripped the band-aid off. People know what the solution is. And my argument has always been that in the pre-COVID world, 2% was an inflation ceiling. My suspicion is 2% will be a floor upon which we bounce off of. And I very much could see a situation where we have 4 or 5% inflation on a sustained period. And all we need to do is look at Trump. Yesterday, he said, I'm going to push Powell to lower interest rates. And if he starts doing stuff like that, and it ends up being that they're running its pro-cyclical fiscal policies, because let's face it, they want to cut taxes. That's also inflationary. If they do all these things, I could see a situation where next thing we know, inflation is back to 4%. And so ultimately, kind of in the next, if you're thinking about long term, you need to expect higher inflation. And with that comes a million different problems. We haven't talked about negative stock bond relationships, which is one of the big things that occurs from that. How you protect yourself from that, what that means for the dollar. There's a million different difficult things that come from that. But I do believe that in the coming years and decades, inflation will be much higher than people expect.
Yeah, and there's so many things pointing to it here. And I love that you brought that up. A lot of people forget like 2019, we kind of saw the beginnings of that stagflationary period. You could even argue that we were kind of heading into a recession anyways.
Right.
That was kind of very easy to see during that period, but everybody forgets about that now because of all the money that flew into the market. And you don't look so crazy today if you're talking about inflation then. And and
That's right.
and it really took off. It took off.
Yeah.
We saw those negative oil prices in April 2020, and they really didn't look back. What I find very interesting about this chart number 3, is the fact that we're at those where oil is at about was at about $60, 65 when it got into the blue zone the last time. And the first two, we're looking at oil prices hitting single digits. That was a time in 99. I think oil was just under $10 a barrel. And then when it goes negative in 2020, and now today, oil at 60 something dollars is all the way back up into that zone. So it's
Right.
it's it's very interesting to kind of just look at it that way because of what inflation has done to the market. So I love that you brought all that up, Kevin. And the one thing that we're going to have to get to now, if we're talking about inflation, we got to talk about gold.
Okay.
So what were you thinking about gold? You had a couple things there. I'd love to hear your thoughts about gold, where it's heading, what it means to the inflation story, and generally what you're thinking here.
Okay. So for gold, I have been a bull for off and on for a lot, but ever since Russia took over Ukraine, I've been a full-fledged, won't back down, consistent bull. And the reason I feel this way is because when the West went and zeroed the assets of Russia, the financial assets of Russia, they created a situation where other central banks looking at that had to put that into their equation in terms of thinking about the safety of their principal. And if you're the People's Bank of China, even if you don't think that'll happen, you still need to consider the possibility that the Americans will now go and just say, "Hey, all those treasury bonds, they're not yours anymore." And it would therefore be kind of almost imprudent to not go out and to start diversifying your your reserves. And so the crux of my argument, the reason I've been so bullish gold is not because of the US dollar, not because of inflation, not because of rates. I have been bullish gold because I think that the People's Bank of China has no choice but to consistently buy every dip and just VWAP that thing and just keep buying it. Because when you look at the size of the gold market versus the size of their FX reserves, the gold market is tiny. They're not going to go out and try to just switch it overnight. They have to do it bit by bit. And that's why whenever I've had folks bring up charts to me that show the multi-regression the of US dollar and the rates versus gold. And if you did that, you got shaken off. And this is why it was kind of interesting. If you look, some of the biggest gold bulls didn't participate in the rally because the relationship between the US dollar and rates completely and utterly broke down over these last 2 years. It was a fundamental change in the gold market. And yes, if we have a situation now where the US dollar goes down, will there be more US financial buying of gold? Sure. And that might cause it to go up. But ultimately, I don't care because I think that the People's Bank of China is who you're really playing poker against. And so, ironically, I think that if China and the US, if Trump were to cut a deal with China and we had a situation where that became less problematic, I still think China would stay on the bid of gold, but I'd be less excited about that from a perspective of a gold buyer because ultimately I believe that China's insecurity about holding American assets is what's driving the price of gold. Full stop. Yes, everything else at the margin is affecting it, but that is the long-term bull thesis. And I've always said this. I think that gold ends with $1,000 up week. Like we get a situation where it just gets parabolic on the upside, and it'll be once China starts picking it up, and then other people try to buy at the same time. It'll keep going. And back to my poker analogy, I think it's funny when folks will get the report out of China and it says, "Oh, China didn't buy any gold this month, so I'm not going to buy any." And I'm like, do you really believe that China didn't buy any gold? Like, why would you, if you were China, let a whole bunch of hedge funds and retail guys front run you? Of course they're going to do it. Not only that, if gold starts to get frothy on the upside, if I was China, I would pull back. I would stop buying. I wouldn't want the thing to take off. My goal in terms of I'm the People's Bank of China is to accumulate the most I can over the next coming years at the best price. So just remember that when you're trading gold, because I think too many people miss that thing and don't realize that they're playing poker against the People's Bank of China.
And I love that you brought up the relationship between yields and gold because once again it's something, and market history better than most people I know. Going back, you go to the 70s and you see the stagflation era. We're in a completely different environment than we've been in for 40 years. And people have to understand that. People have to start trading like that. Look at the copper to gold ratio. It followed yields perfectly for many,
Yeah,
many years. And now it's just completely,
right,
the jaws are wide open. It's a completely different relationship these days. So I think it's something that people have to really start to open their mind to, is that this is a very different environment. This is an inflation environment. We have to understand how we need to trade that. And it's going to be very different than it's been for the past 40 years. I mean, that
right.
started in 1982. No, none of us have traded through that. There's very few people, and I get to talk to a few of them, which has been great. However, most of them are so young at that time that they don't really remember trading it well, you know?
Right. And
Uh,
there's nobody that remembers tariffs because
yes.
tariffs were like before that, right? And so the
Smoot
reality is,
Hawley would be
yeah,
one of the big ones, right? And
yeah,
then getting into the 60s, maybe with the steel companies, but that's
yeah,
it.
yeah. No, I'm with you. This is a definitely a different change, and I kind of joke and say make macro great again. And that's in essence what's happened. We have a situation where macro is going to influence these things much more than people realize, and we're going to see moves like we haven't seen. And I look at this lastly, everyone's getting all excited about the fact that this post Trump winning, that there seems to be all these crazy things happening in the stock market and in the foreign exchange and in the bonds. And I'm like, you ain't seen nothing yet. This is going to get way worse in terms of volatility.
No, I completely agree, and it's going to continue to get interesting. So speaking of interesting, you being from Canada, you absolutely hate the Canadian currency. I see it every week, even though for me, I'm like, man, the COT signals look really good.
Okay.
So, what are we seeing here, Kevin? Because you really hate the Canadian currency, and I'd love to hear your opinions on it, especially with the dollar thesis. We have the dollar thesis, and once
Right.
again, you brought up a great point the other day in your writing, which is if you're bullish on the Canadian dollar, that means you have to be bearish on the other side of the currency. So let me
Yes.
hear your currency thesis and how you're looking at the Canadian dollar or any of the currencies right now.
So in terms of currencies, they're all generally measured against the US dollar. And so this is the problem. And I think that the US dollar will be one of the worst performing currencies. The only one that might be even worse is the Canadian dollar in the coming years. And let's just go over my thesis of why I hate the Canadian dollar. And before we start, I'm from Canada. I love my country, even with its cold weather and everything. I think that we're going to do great over the long run. And it's not like I'm always bearish on Canadian dollars. Someone that accused me that the other day said something like, "Oh, you're just like the Brits that always hate the pound, and or the Australians that always hate the Australian dollar." I said no, and I actually went and pulled up a report that I had written in 2020 when the commodities started going up in the first days of post COVID. And I was like, you got to own the Canadian dollar. So it's not like I'm always bearish, but here's the kind of, I'll give you why I think that the Canadian dollar is going to struggle and we're in a secular bear market for a long time. We had a situation where in the kind of period from 2000 to 2008, we had a housing increase like you guys did in America, but it wasn't anywhere near as much. It just wasn't. You guys took it to a new level. And then 2008 hit, and all of a sudden there was too much debt in your system and it rolled over and nobody could get debt. If we remember back, Ben Bernanke, he tried to go and renew his mortgage and they couldn't get it. He couldn't get his mortgage renewed because of the rules with the bank. During that period, our Canadian banks were much better shapes and we continued to lend. And not only that, because of the post GFC era, interest rates went way lower. So we had this situation where all of a sudden rates were extremely low. We have a lot of immigration in Canada, a lot of reason to grow. Our banks were strong, and people just kept buying and buying and buying and buying. And the private sector, the consumer side, started putting on huge amounts of debt. And I can't remember the exact number, but let's just say that the America took it up to 100. I think Canada at the time was 80. You guys had the great financial crisis that got chopped down to 70% in terms of this is numbers as a percent of GDP, consumer debt as a percent of GDP. So you went from 100 to 70, I can't, something like that. Well, we've gone and we've taken that number. So we passed you guys, and then we took it up and took it up and took it up, and we actually took it to an all-time high. Can't remember the exact number. It's 120 or 130. It's like some just obscene number, meaning that we just continually strap more and more debt on as we kind of blow this huge real estate bubble. And along the way, I remember very distinctly, very like, some financial newsletter writers that were very aggressively short Canada and talking about how you guys up there are going to learn what it's like to experience a bubble crash and this is going to be a disaster. And I kept saying, I don't see it. There's no real impetus. Like the reality is that rates aren't going up enough to cause any real pain. The economy's fine. So we have this situation where it just continues. So then the COVID hits, and we obviously all have problems. Rates again were made to zero. But this time, on the other side, as everyone spends money, we get a situation where all of a sudden we do get inflation, and rates start rising, and they start rising in a big way. And one of the things about America is that you guys have that wonderful thing called the 30-year mortgage. So most people, when rates went to zero in the post-COVID era, reset their mortgages. They just said, okay, great, let's just go reset it. And this is part of the reason that American central bankers like Powell have had to raise rates so aggressively is because the monetary transmission mechanism is muted because everyone that could extended the duration of their borrowings. Well, in Canada, the longest we have is 5 years. And yet we had just the most out to lunch, clueless central banker that decided he was going to be cool and was going to actually be more aggressive on the hike cycle than Powell. So we were raising rates at a higher clip. So we had two things. We had our housing market was more expensive with way more debt, and yet yet he was raising rates faster than you guys did there. And then to top it all off, this is the real problem, is that we had this weird situation where in 2022, when there was all of a sudden problems with not enough labor, the Canadian government went and just opened the floodgates in terms of legal immigration. And we had the largest increase in population growth than we had had since the baby boom. It was just off the charts. We're roughly 35 million people. I think we were bringing 1.2 million in a year, like just monstrous. So when you went and looked at our GDP numbers actually didn't look so bad. I can't remember the exact number. I think it was 1.9 for 2023. That was our real GDP growth. And it was the second highest after America. It looked great. Like Canada looked terrific. But then when you go and you equated that to a GDP per person, we went from being number 2 out of the G7 to being dead last. It actually went from a 1.9 or whatever to a minus 1.1 or 1.9 or something like that. The difference was huge, meaning we augmented our growth with just huge amounts of immigration. Now, the problem with it is, listen, we're all immigrants here in Canada. Immigration is terrific. It's a lifeblood of our economy. They're hardworking people. But the trouble is we couldn't sustain them. We didn't have the housing. We didn't have the infrastructure. It was just problems all around. We weren't doing them any favors. We weren't doing us any favors. But it was a terrible policy by the Canadian government. And now the real problem is we've gone from one side of the boat of letting in tons and tons of people to the other side of the boat where we've said, now, instead of actually having immigration growth, we're going to send some of those people that were on temporary work permits that we're expecting to get permanent. We're going to send them home. So we're going to go from letting in 1.2 million to actually sending back 50 or 100,000. And we're going to do this almost overnight. And our economy this is going to be brutal for our economy. This is going to be terrible for our real estate. We're going to see a situation where the whole thing rolls over. And one of the things is you mentioned people trading their politics. We have a situation where Trudeau, our leader, is going to step down, and there's going to be an election, and we're going to have our own right wing guy that's supposedly going to be very business friendly and stuff like that. And I have no doubt he's going to do a lot of positive things for the economy in terms from a pure economic point of view. Having said that, he's already said he says, what was his line? Let me just get this right. He goes, Justin gets the party, I get the hangover. The reality is that the Canadian economy is so lopsided with in terms of our reliance on real estate and our over indebtedness of this thing that we're going to see a situation where it's going to take years, maybe a decade for us to, reprice this. And the reality is the easiest way to do it is to leave our dollar really, really low. And that is the tried and true way. Unfortunately, you guys, as being the reserve currency, you couldn't do that in the GFC because you couldn't devalue against the rest of the world. With us being a smaller economy, I'm pretty confident that this is the out that we'll take because we can't afford to have housing price decline in a nominal basis. So what we're going to do is we're going to fix it by having it decline in a real basis. And the way you do that is you run your economy hotter than it should be with lower interest rates and you let the dollar go down. So back to the newsletter writers, I kind of thought it's kind of funny because there's one guy in particular that was literally foaming at the mouth bearish for years, telling us that we were going to get our Jets desserts. And now, just as this thing is turned and as the real estate is finally popped, and this is about to be kind of the beginning of a secular bear market in real estate, he's gone all bullish talking about how much he loves Canada because we're going to get the right-wing political guy. Put your politics aside. Macroeconomic kind of cycles are drive the economy and markets way more than whatever government can do over the short run.
Absolutely, and that's well said. If you look at, seasonality isn't very tradable all the time, but it's something that you can kind of understand a little bit about human action from, which is just look at the elections. After the election, it's almost always bullish. It doesn't matter who gets in office, what party they're in, incumbent, not an incumbent. Most of the time, the market goes up afterwards. It's kind of like, once again, like you said, macroeconomic factors really matter. And I
Yeah,
think that's a great way to end it because, like you said, macro matters. Macro is getting very interesting right now, which is very exciting for me, and both of us as macro guys, like just to see these markets kind of go through these trends and the reversals and thinking about more out of the United States, thinking about commodities more and so on. It's going to be some fun times to be a macro trader. So,
completely agree. Completely agree.
Kevin, I just want to thank you so much for coming on, man. This was a lot of fun. Make sure where can people find you, Kevin, to find a little bit more about you, read all the stuff that I read from you all the time.
Sure. So you can go to the macrotourist.com. And if you want to see some examples of my newsletter, just send me an email, Kevin at the macrotourist.com, and I'll flip you off some of my recent writings.
All right, guys, that's Kevin Muir from the Macro Tourist. I'm Jason Kurz from Against All Odds Research, and this is with Stock Market TV and All Star Charts. We'll see you guys soon.